Another example of a big horizontal M&A, just 3 weeks ago, was a German IoT company that bought InstaDeep, a data science platform in Tunisia, for 585 million euros, something like that. The problem with vertical M&A, when a bank buys you, or an insurance company buys you, or an e-commerce giant like Naspers buys you, is most corporate M&A is done for the wrong reasons, because of FOMO, right? You have a piece of technology that they don't know how to use. You're more in touch with end customers. So they would buy you as a defensive strategy, not an offensive strategy. So the multiples that you can get on revenue or your earnings are significantly lower. However, because corporate South Africa and corporate Africa is very acquisitive because of defensive reasons, you'll see firms like Sanlam, Old Mutual, Naspers, MTN acquire a lot of startups, but for very low valuations. So in theory, Africa had 125 exits in the last 4 years. 125 exits. People don't know this, but most of these exits are undisclosed, corporate M&A at negligible multiples of revenue, right? The other exit opportunity is an IPO. But how many IPOs have we had in Africa in the last 5 years? Anyone? Mikhail? We've had a few IPOs in local exchanges, but in global exchanges, one, Jumia. Right, so the reality is, from an exit perspective, the only viable exit opportunities for VCs is secondaries. So you come in very early, pre-seed, seed, Series A, and when a company gets to about $100,000 in monthly recurring revenue, you can then sell your stake to bigger VCs, typically international VCs. Why is all this important for you as a founder, you might be asking? Because if you don't think like the investor and know why we need to have a path towards an exit, how can you ever understand why we would back you, irrespective of how incredible your pitch deck is? So more mature founders or more wiser founders will, even as part of their pitch deck, tell you, listen, I think if we play our cards right and we get to a critical mass of this revenue and this traction, we are a perfect M&A candidate for ABC. They've spoken about this piece of technology that they can't build themselves, so we think we're a great candidate for a sale. That is a founder that has done so much research into even a potential exit in 4 or 5 years. Those are founders we absolutely love, because you've put yourselves in our shoes. And what's important for us? Distribution, channel, partnerships, sales, making money, paying it back to our investors. So when people ask me, Zach, how do you pitch to a VC? That's how you pitch to a VC, right? But it requires a lot of effort. Now, it's not the CEO's responsibility, the CTO's responsibility, the CEO's responsibility. It's everyone's responsibility. From developer to designer, you have to constantly have your pulse of what's happening in the market. The number of founders I meet that have no idea who their competitors are. Shocking, absolutely shocking. And as VCs, we see hundreds of pitch decks all the time. So we have the added insight of knowing what's happening in your space. And if you haven't made the effort to know who your competitors are, what their margins are, what their take rates are, what their month-on-month growth rates are, and you expect us to do all the work, how is that fair? It just reeks of either arrogance or ignorance. And I'm not sure which one's worse, right? I'm going to skip through this. Gosh, do I even have time to walk through math? Okay, I'll try and do it in 2 minutes. What do you think? Okay, I'm being extremely conservative here. What do you think a good return in the stock market is in dollar terms? Or what would you be, like, what is the average return in the stock market in dollar terms that you'd be okay with? 7 to 8%, 10% annually? Assume that you're in the US for a second. So, okay, I'll make it easy. I'll just give you all the answers. If you were to make 12% in a very risky asset class like VC, would you be happy? How many yeses? How many people think that investing in startups that are unlisted, unregulated, have no liquidity, and have very few customers, it's okay to put your money and make 12% a year in them? How many people think that? Come on, guys. Can we get some coffee for the audience? Okay, you want to make at least 25% annually to make up for your risk. But let's assume that I'm the kindest human being on the planet, and as a VC, I'm okay making 12% on extremely risky investments. That means basically I'm a unicorn, because that doesn't exist. But let's assume that I'm happy with 12% on extremely risky startups that change the world. I mean, Tesla, Amazon, Uber changed the world. They were risky startups. But if I'm happy making 12% compounded annually over 10 years is 3x. Right? Just trust me. You can open your calculators later, but it is 3x. Right? Now, what percentage of VCs today are making 12% for their LPs annually? Less than 5%. So less than 5% of VCs are giving their investors 12% annually. Right? So I'm going to walk you through some numbers here. I'm going to just talk through it because the font is too small on the next page. I'm going to give you, this is way too small. If you can read this from that far away, come work for me because I need some good numbers. Let's assume a VC has a $100 million fund. Just work with me for a second, right? And they make 10 investments of $10 million each, right? I'm making an assumption here that there are no management fees, no inflation, so I'm being extremely conservative, right? And I say that every single investment I made, the company ends up being worth $50 million at Series B. Series B is typically, if you're investing at Series A, seed and Series A, that's about 4 or 5 years from a timeline perspective. So out of the 10 investments that I've made, every single one was worth $50 million upon exit, which is pretty bloody good. Do you think I've made money for the fund? I haven't. Because most VCs, if you invest at Series A and Series B and top up at Series B, you tend to own between 20 and 25% of a company. 25% of 50 million is $12.5 million. Times 10 companies is $125 million. You won't even get close to 3x. Remember, 12% over 10 years is 100 to 300. Are you with me? Right? That's 125. So let me give you an example. What are $50 million companies in South Africa? Give me examples of some $50 million. So $50 million is what? The rand fluctuates a lot. But what is $50 million in rand? About, what is it? 50 times, what is it, 17? So 300 and, gosh, help me. It's how much?
Almost half a billion.
$500 million rand. How many $500 million rand tech startups are in South Africa? Not a lot. So you're saying I back 10 companies and all 10 of them get to $500 million rand valuation. And I still don't even get to close to $300 million. And even if I did, that's 12% a year, for fuck's sake. So just edit it. Well, actually, keep it. Right? So that's one scenario. Second scenario, 5 of them are worth $50 million, and 5 are worth $100 million. That's, what is it, 1.7 billion rand. Guess what? You know the math. 187.5 million. Still not 300. Still not enough to get you to a 12% annual return. 5 sell at 50, 4 at 100, and you have 1 at $500 million. Still not 300. Just assume the number is right? Unicorns. South Africa has no unicorns. But let's assume that You have one unicorn. 9 of them sell for $50 million. So again, no failures. Assuming none of my companies have failed, the worst company is worth $50 million. The worst company is worth $50 million. And one of them is worth $1 billion, 17 billion rand, or 1.7 billion rand. No, 17 billion rand, sorry. By the way, do you know what the market cap of Nedbank is? It's about $2 billion. So you want someone to become as big as Nedbank in 5 years. Just perspectives, people. Perspectives. At that point, so you backed a company that in 5 years becomes as big as Nedbank. In 5 years, 5 to 7 years. And then you've made 362 million, which is about 14% per year. What the fuck? What the actual fuck? Why am I saying this? I'm saying this because VCs aren't for everyone. When you walk into a VC's door, we expect you to be this guy. So you've got to tell us, how are you going to be worth as big as a bank in South Africa in 5 years? You know what? That should be the new mantra. Fuck all the numbers. Just become as big as a bank in 5 years or 7 years. Then I'll talk to you. Right? Geez, that might be trending on Twitter soon. Fuck. I hope no one from Nedbank is listening to me. But it has been done before. Flutterwave, Stefan mentioned in the address. I was one of the first investors in Flutterwave in 2016 when they came out of Y Combinator. The valuation then was 10 million, and Flutterwave is worth 3 billion in 6 years. So it has happened. It does happen. And when that happens, you make a shitload of money. But how many Flutterwaves exist? There are 7 unicorns in Africa as of January. 5 in Nigeria, 1 in Egypt. That's it. And there's one more, which is sort of Egypt. South Africa / Australia, but yes, go on. Right? So, purpose of this is VCs are not evil. This is not an evil face. This is a happy, smiling face. But it is bloody hard to make money in VC. It is bloody hard because we expect you guys to basically become a bank in 5 years, as big as a bank in 5 years. But once you take money from us, we will bend over backward to help you, because our lives and our LPs' lives depend on you. So please do not be upset if VCs say no to you, because there are hundreds of other ways to fund your startup. If you do have the privilege of having VC money, consider it a start of a good, symbiotic, synergistic relationship, and work your ass off for your investors and for your employees. Right? Okay, we still have some time left. I'm going to go through 10 things that you should remember when you start talking to VCs, right? I'm not going to read this, but high level, verify, verify, verify. Everything. Your idea, your team, your proof of concept, your source of your investments. Why? Because if you don't verify, we will verify it for you, and you will never get money from any other VC for a while. So basically, don't lie. Right? And don't make up stuff. If you don't know something, say you don't know. Right? Find the right investors. It's very important to find diverse investors, so try and have multiple investors on your cap table, angels, VCs, family offices. Look for VCs that have a track record of being supportive. There's a slide a bit later that talks about what value you should ask from your VC. Fuck it, I'll just give it to you now instead of waiting for slide 37. Is when a VC backs you, if you're lucky enough to get money from a VC, ask them for any of 7 or 8 things apart from their money. Ask them for media contacts. If you're a founder, and every founder here thinks they should be on the cover of Bloomberg or the Wall Street Journal. Not going to happen. Right? Monobushi, but it's not going to happen. Do you know who can make it happen for you? A VC can. Not all, some. right? VCs can help you with media coverage, getting you into conferences, summits, pitch days, just get you tons of exposure, provided they've backed you and they believe that you can become what you say you're going to become, right? Number two, ask VCs to help you with cross-border expansion, right? Unless you're lucky to be enough to be in Nigeria, where there are more Nigerians than the adult population of the US, and you can be in Nigeria your whole life, chances are you need to expand beyond the Limpopo River if you're in South Africa. Who can help you with that? Chances are your VCs can link you with other portfolio companies to expand into other markets and not be an also-ran, right? So ask them for cross-border expansion. Ask them for help with legal, with IP, with tax. VCs have people that do this inside their organizations, and they would be remiss if they didn't help you because they've got money in your company. Ask your VCs to help you with hiring. We are not recruiting firms, but we do get a lot of CVs. We can help you with hiring. You gotta ask. After you've done some work yourself. Don't just assume that we'll do it for you, but ask your VCs to help you with that. Ask your VCs to introduce you to other VCs. Ask your VCs to introduce you to their LPs. LP as in limited partners in funds. A lot of good VCs will offer free co-investment rights to their LPs. We're one of the few that does. Ask your VCs to introduce you to LPs. The whole bunch of things. Ask your VCs to help you with access to later funds from a commercial traction perspective. What I mean by that is not funds, corporates. So if you're struggling to close a contract with MTN or Vodacom or Sunlum or Nedbank, ask your VC to help you. It goes a long way, right? So the right VCs will add significant non-financial value above and beyond their check. But they'll do that after they've backed you, not before, clearly. Right? Data and realistic projections. Gosh, the number of spreadsheets that I've seen that show you getting to $100 million in revenue in year 5 is absolutely atrocious. Yeah. I actually went through this exercise with my first fund, Startup Bootcamp, which, by the way, has paid all capital back to its LP. So, by the way, as a VC fund manager, as an aside, the best way to get money from LPs is what? To return capital to your previous LPs. Traction begets traction. The same thing applies to startups. Why do repeat founders raise money so quickly? Because they've got evidence that they're not just big talkers, but they're actually doers. So when you show projections, be realistic, right? By the way, at the early stage, no one cares about your financial model, because the only thing about a financial model is that it's going to be wrong. Listen, I used to build models for 10 years at Lehman Brothers and Barclays, and it was bloody hard. But why do VCs, you might ask, why do VCs ask for a financial model? Why do you think we ask for financial models? If we don't believe them? Come on, someone. To see how you think. So you know what the perfect litmus test is for a VC? Is I'll call a CEO into the room, and he or she will say, well, is this a financial model thing? And I'm like, yeah. Oh, can I bring my CFO? I'm like, no. No. Your CFO sits in the corner and doesn't talk to you, doesn't look at you, doesn't make eye contact, preferably out of the room. You're the CEO. If you can't tell me how you're going to get to $50 million in revenue and $100 million of EBITDA in year 3 or year 4, why should I trust you? Your CFO is a glorified accountant in startups. Late stage companies, of course. So essentially, I will look at your financial model, but I'll ask you to explain how you got to that point. So I'll give you a short example, 30 seconds. A company in Kenya that was building virtual addresses, incredible piece of technology, and they had a number on their deck that said, year 3, we have, 89,000 users paying us 100 shillings each, and we get to this. I'm like, cool, can you backtrack that and tell me what your target market is? And then I go out, because we've done this a lot. Okay, the population of Nairobi is X. And even if 10% of Nairobi folks sign up to this, and you assume a certain amount of churn, you're never going to get to that number. And the guy says, no, but the financial model said it would. So do I care about your financial model? No. Can you explain to me, on the back of an envelope or a napkin, how you can build from bottom up your projections? If you can't, and it doesn't loosely tie into your financial model, you've lost me, or the VC, right? So VCs ask for models to see how your mind works. That's it. And a little secret, VCs actually hate financial models. Do you know why? Because startups have no fucking idea how to build financial models. I'm being honest. When we hear that there's an investment banking associate that's joined the team, we suddenly perk up because we can read and make sense of those models. But most financial models are built off of templates on the internet. Come on, I caught you guys out, right? So we just ask them to see how you think. That's it. So be realistic on your data. Scale, think global. There's a reason why South Africa has no unicorns or even half unicorns. Forget regional business models. In order to attract serious investors, think about a scalable business on the first day. You don't have to be live in Japan and China tomorrow, but you have to have a path towards getting there. And the best way to scale is through partnerships. Right? You read that later, right? I put this in a while ago, and this is not to curry favor with Stefan or any Swedish or Norwegian or is that Finland? Denmark, Danish. Have Nordic DNA. What does that mean? Not actual DNA. But if you look at startups in Estonia, Latvia, Lithuania, Sweden, Norway, the Baltics and the Nordics, their products are fucking gorgeous. They're just beautifully designed. There are only 10s. I'm sorry. Why is that important? If you look at the number of unicorns and $100 million companies coming out of the Nordics and the Baltics as a fraction of a percentage of their population, it's the highest in the world. Why? They have very small populations. Israel is a very close, similar sort of region. They think global from day one because they know that if they stick to their home markets, they're toast. They're lean, very lean. They maximize product optimization with very few team members. And they put a user-friendly design at the forefront of everything they build. Have you ever seen a bad-looking, Swedish sofa? If you have, let me know and I'll just avoid them. But design, super important in everything you do, right? So Nordic DNA is not because you have to be Nordic, but the way you think. Israel, another fantastic example of how people have built startups there with a tiny economy because they think global from day one. And part of that is also figuring out where you register your company. So out of the 130 companies in our fund, we are a Pan-African fund. But all the non-South African companies in our portfolio, which is about 80%, all have their IP where? Delaware, London, Singapore, Ireland, Mauritius, Netherlands. And where do the Saffers have their IP? In South Africa. Why? Because we love our braais and we love our whatever. And our load shedding. So the point is, being patriotic will get you only so where. The reality is, if you want to attract global VCs, smart capital, you need to move your IP offshore. That does not mean that you don't create revenue, jobs, and pay taxes here. Flutterwave, the most valued African tech startup, employs all its engineers, developers, and employees in Africa. They pay taxes in Nigeria, in Kenya, in South Africa. Yeah. But their company is in Delaware. Go figure, right? So, social, mobile, local. Always try and find solutions that work in your region. Uber started off as a service for limo drivers in San Francisco. They proved the model right, had ridiculous customer satisfaction, and then scaled. They were local, then they were mobile, and then they were social. Nice ring to it. So-mo-lo, right? Take risks. I mentioned this before. Risk takers, why would anyone else invest in business if you're not willing to risk it? Gosh, I have too many slides. Should I stop or should I just go on for a little bit more? More? Okay, cool. For those of you that have not launched a proper fundraising campaign, how many of you guys have launched fundraising campaigns? Yeah? How do you launch a fundraising campaign? I should be a professor. First impressions count. Spend time to present a compelling story. Get advisors on your advisory board. Have a really professional deck. I cannot emphasize how important a deck is. Number two is one of the biggest issues we have is updating people in progress. The moment people get a check from a VC, all of a sudden, how many of you are familiar with people that ghost you? It happens in our world too. We get ghosted by our own startups. So and then they give them shit, say that you'll never get a penny from us again. And we'll tell all our friends in VC, never give you money. Oh, I'm so sorry, I'll send you a monthly report. Update people, updates.